Dropbox stock year to date is up 20.83%. Over the past year, though, it's about that same 26% performance, and over the last 5 years, it's shockingly down. Now, this has been one of the big positions that I've bought this year. I started my position in February, buying 1,500 shares. I have trimmed it down to 1,000, but I still have a considerable amount of my money, around 25% of my invested net worth, inside of Dropbox stock. Now today, we're going to give a brief overview of what this company looks like, what I think the projections over the next year or two are going to look like, and how I think that it's going to benefit me as an investor to be invested in this company. Its paying users are growing, its revenue per user is growing, and generally speaking, revenue, free cash flow, shares outstanding, and everything of the like is going in the direction that I need it to. Now, Dropbox is going to be a fun one to get to in this video, but that's not going to be the only thing we're talking about. Today, we're also going to be talking about the Activision Blizzard Microsoft deal. Microsoft, in case you weren't aware, is wanting to buy Activision Blizzard. Now, the judge did rule against the FTC and deal in Microsoft's favor, and in my opinion, I think rightfully so. We're going to talk about what caused this decision and what the FTC is doing in response to this, and whether or not I think this deal will end up going through. Then lastly, the last thing that we'll go over is Threads. 5 days just into this company's release, it reached 100 million users. We're going to talk about whether or not this is a big win for Meta, how it will affect companies like Twitter and other social media businesses alike. So it's going to be a fun one, a busy action-packed video. I ask that you subscribe, like the channel if you haven't already. I always give updates to my portfolio and companies like this and any and everything related to the stock market. So thank you guys so much for watching. Without further ado, let's go ahead and get started by looking at my portfolio and the company Dropbox that we're taking a look at today. Here's my performance so far year to date versus the major indexes. We're doing quite well, and a big part of this gain is coming specifically from Dropbox. We're up $6,635 as of the time of me filming this video, which is about 32% gains. Now, this is pretty impressive considering that I've only invested in this company for about 5 months. I knew that it would come back, at least I thought that it would come back when I originally invested in it, but I did not know it would happen this fast. It is eyeing almost $30 now. As of today, it's $27.41, and I originally bought this company right around the $20 range. So it's went up quite nicely, quite quickly. Now, the funny thing is that if we look at Qualtrim here, it is not even remotely close to its all-time high. After it IPO'd right around the $30 mark and reached an all-time high shortly after, just above 40, right around $42, $43. But pretty much it's been flat. Since IPO, it's actually down 3%. It's right around where it went public at, despite this company having 5 years of continual growth. Now look at where this company has done its revenue over the last 5 years. From when this goes back to the beginning of 2017, 6 years later in the first quarter of 2023, it's increased its revenue all the way from $248 million to today's $611 million. Now not only have they increased their revenue, but if you look at that first quarter of 2017, they did $56 million in profit and actual free cash flow, and now that $56 million has over doubled to $138 million. So they've increased profitability, they've increased revenue, but it gets even better than that. They have decreased their shares outstanding, which means you now own more of the company just for simply waiting from the time this company went public. Just a couple of years ago to 2020, they had around 420 million shares outstanding, and from that 420, they've decreased it all the way down from 420 to 350. Now that is pretty significant downturn, and as of the last quarter, they're buying back almost 5% of the company back each and every year. Now furthermore, this company has a pretty solid balance sheet. If you look at their cash versus debt, they're currently unlevered. Their cash and debt pile is almost identical, cash at 1.25, debt at 1.2, so they could pay off all their long-term debt tomorrow, and I think that they're about to start putting up record profitability. I think next quarter will be $200 million plus in free cash flow, but we'll see. I think that they're going to start buying back a lot more stock and reaping rewards from their investments in their core business, and the profitability is going to skyrocket, not only because their core business growing as well, but because this right here, this kind of pinkish, reddish color, the G&A, the general administrative, they just let go a pretty considerable portion of their staff so they didn't have to reinvest in their unprofitable segments of the business. So actually their profitability is going to increase because they don't have to pay nearly as many employees, and that's going to save them millions of dollars every single year. Now this company is targeting free cash flow this year of $840 million in the midpoint, but next year they're projecting $1 billion. Now $1 billion of free cash flow is pretty impressive for a company that trades under 10 billion. So the free cash flow yield is looking quite nice for this company. And remember, this is after the company has already risen over 30% from the time that I invested in it. It's a $9.62 billion company right now, but it wasn't too long ago that I was investing in this business, and their market cap was around 7 billion or so. So a $1 billion free cash flow number for a $7 billion company, if they're able to put up this number next year, would be absolutely incredible. Now their margins are going up as well, as they write about here, but mostly this is coming due to their amount of paying users increasing every single year, and the average revenue per that user also increasing, so they're becoming more efficient, more profitable, and obviously that reaps reward to shareholders as the amount of users goes up, the amount of user that everyone pays goes up over time, and obviously that leads to substantial increases in revenue and profitability, and this comes from an array of products through all of these lineups that you're seeing on the screen right now, from basic, plus, family, professional, pro, e-sign, standard doc e-sign, advanced, and enterprise. And enterprise is a big money maker, and they typically renegotiate their prices in the first quarter, which is why you see a decrease in free cash flow right here, typically around quarter one, right here, and right here every single year of the business, and then they normally pick up around quarter 2, 3, and 4, and that one little quarter is normally a mishap. Long story short, the reason why I'm telling you all this is because the company has went up a lot from where I originally bought it. Like I said, I did own a maximum of 500 shares at one point, 1,500 shares, and I did sell out of 500, and I only own 1,000 now. I'll probably be selling out a couple hundred more once we reach $30 a share, if that's any time in the near future, and then I'd probably sell completely out around 35, 40. Now that's still a long ways to go. We may not get there, I could be completely wrong, but I think we will. Now my opinion is I want to hold this company and slowly trickle out as it goes higher. Now, the same thing goes if we were to go back down. Right now, we sit at right around $27 per share. If we were to trickle all the way back down to $24, $22, $20 a share, I would be buying right back into this company because I believe it for the long term. I don't think we'll ever see $20 a share again, but I could be wrong. And guess what? I already reaped some rewards and already took some profits off the table if that's the case. So if you want to follow along aside me with this Dropbox investment, this is how I'm taking this company actively in my portfolio. I'm buying it in the low 20s, selling it around the $30 to $40 range, and hopefully 6 months, a year, 2 years from now, you can see me selling fully out of this company at $40 plus, and hopefully it will have been a big gainer for my investment portfolio. Now next up we have Microsoft and Activision Blizzard. This was a company that I originally talked about investing in a couple months ago, and we didn't pull the trigger because we had other investments at the time, but ATVI stock, which is Activision Blizzard, saw a big uproar just the other day. They went up from about $82 all the way up to $91 off the news off the back of this deal. Now the judge that did rule over this deal ruled against the FTC and ruled in the Microsoft side of this deal and ruled in their favor. Now they're saying that this is not going to be too competitive. It is not going to restrict actively in the market against a lot of big name brands like Call of Duty and a lot of other exclusives. And the funny thing is Microsoft has actually already stated that they don't plan to take a lot of its big names like Call of Duty exclusive away from big consoles like PlayStation or PC and make it exclusively on the Xbox. I think it's reasons like that that the judge ruled in favor of Microsoft and not in favor of the FTC, I mean. But if you look at Microsoft, right now Activision sits at around an $80 billion valuation, which is what Microsoft would have to buy them out as. But out of $80 billion, that sounds like a lot, but currently Microsoft has on hand a little over $100 billion. Now, I don't think they'll use all cash for this deal. I think they'll use some debt, maybe some shares, but likely it'll be debt that they'll use. And considering that this company is also unlevered, only at $41 billion of debt outstanding, I think they could easily probably raise something like $20 to $40 billion of debt and then use the remainder of their cash. And considering that this company has $100 billion in cash just sitting there going unused, I think this would be an accretive acquisition for shareholders of Microsoft, because right now the company does considerable amounts of revenue and considerable amounts of profitability, and their core business can only grow so much, so they need to go through with big acquisitions like this to really help boost up that revenue and profitability. Now in terms of profitability, this is going to generate active profits for acquiring Activision Blizzard at around $2 billion a year if it assumes any type of profitability like we've seen the last couple of years from Activision. And while paying $70 billion, $80 billion or so for Activision may be a lot, it'll instantly accrete about $2 billion of free free cash flow, but it will also give Microsoft more leverage to acquire things like their Game Pass, expand into a new category, enter the gaming space, and leverage their other suite of software products into opportunities that they wouldn't have otherwise. So overall, I think it's a good deal. I hope that they rule in the active favor of Microsoft and Activision and not towards the FTC. Now, the FTC is already trying to appeal this deal, but frankly, I think it's at a loss, and I don't think that they'll succeed in this. Now, lastly, I want to talk about Threads. Threads has come out of nowhere and actively gained 100 million users, seemingly in less than a week. In 5 days, they have been an active competitor against Twitter, and this is what Meta does. Meta actively copies and competes with some of the biggest social media giants out there. Now, they've done this before, like for example, they've done stories on Instagram, and now they're doing Reels to compete with TikTok, and now they're doing Threads to compete directly with Twitter. I think that there's a reason this company year to date is up 150%. Now, I'm not an active investor in either one of the last two companies we talked about, Microsoft, Activision, or Meta. I'm not investors in any of these companies, but you've seen Meta come basically out of the gutter. It bottomed out at $88. Today, it trades right around $311 per share. And like I said, year to date, it's up 150%. Over the last year, it's up 90%. And now over the last 10 years, it's now back up over that $1,000% performance mark. This has been great for Meta shareholders. And whether or not Threads will actually, quote, kill Twitter, I think there will still always be a market for it, but especially a lot of signs on the political scale that Elon Musk has disappointed and honestly, frankly, got a lot of people on the left side mad since buying Twitter. I think a lot of them will flow towards Threads, and Meta is going to continue to do what it does best. Copy, replicate, do whatever it needs to do to compete with a lot of these social media giants. And while I think 100 million users is really impressive in just 5 days, I think it'll probably be around 5 months to 5 years before we see 1 billion users, 10 times this amount for Threads, and not going towards companies like Twitter and other social media giants that frankly can't compete with Meta's dominance. But other than that, guys, thank you so much for watching. I appreciate you watching all the way to the end. Subscribe and check out the links down below. But other than that, I'll catch you all next time.